So cash flow forecasting is another one of those things that feels like it should be complicated, but I promise you it is really very simple. When you start to break it down and you see what parts there are to it, you can recognise everything and you can understand why it's built the way it is. So the key word here in cash flow forecasting is the cash part of it. What we're worried about with cash flow forecasting is, will we make it through and have enough cash to pay our debts each month? If we think about a huge company like Debenhams at the moment during the pandemic, we recognise that they have gigantic millions and probably billions of assets, pounds of assets. They possibly own their land and the shops. They also have all of that stock in the shops. So they are worth an absolute fortune. However, because of lockdown, the shops are closed, and if we ignore the online sales, they still have to keep paying certain debts every month. For example, the last month's stock that they purchased. But the money will not be coming in, the cash will not be coming in. So while they have huge amounts of assets, they do not have the cash perhaps each month coming into the lockdown. And if they stop having cash, then they can't pay debts, and we'll look at why that is a problem later on. So it's important that we think about the difference between cash and profit. We know that long term the company wants to be making profit, but it has to keep its eye on how much cash it has to pay all its monthly debts every month to make sure that it can make it through from one month to the next. So a cash flow forecast, I've got two copies here that look almost identical. I just found them with slight differences. It's possible, and in the revision book that you use, they don't do as much formatting, but I like these versions because they have a little bit more formatting, which makes it easier for you to see what it is that is part of this process. I'm just trying to see if I can pull this box down a little so you can see it. Okay. So what do you need to know for a cash flow forecast? Well, we're talking about the flow of cash. So we're talking about money, cash flowing in and flowing out. So we talk about the inflow in a month. Usually it may consist of, in this example, the small example, there's a capital injection, there's a cash injection right at the start, often for a new company or business or project. There will be a big inflow in the first month. The biggest inflow will be from sales. By far, usually the biggest inflow is from sales. And also there will be delayed money coming in that you have been promised for a set time, which was in the future, as it comes up, from debtors. And because we're talking about cash flow, we only put the debtors in on the month when they actually pay us the money. So although they may have bought something from us perhaps in January, these debtors haven't paid us until February, so we show that as coming in February. We also need to look at outflows. So usual things that consist of outflows, utilities, wages, your rent, there may be fees, you may be renting a van, you may be paying marketing every month. What else have we got? Insurance, telephone, that comes under utilities, a website. You may have to pay out a particular amount of capital to someone, and you may perhaps have suppliers. Of course, when you buy, it's surprising this one doesn't even include that. When you buy stock, you have to pay your suppliers. And it's possible there may be a delay in that as well, a creditor delay in that. But in this case, we just are paying on the month that we buy the goods. And notice that the inflows are added together. Here there is only one column. Here notice the inflows are added together. And the outflows are added together. So we have the total in and we have the total out every individual month. We then work out the net cash flow. Net sounds complicated, but all it's saying is the in, take away the out. So what is the difference? What has come in and what have we had to pay out? What do we have left? Notice common annotation is you either have a minus where the number is minus, obviously, or sometimes you get that value put in brackets to show it's a negative value. You then start with your opening balance, and then we take the net cash flow away from the opening balance. So in this case we are at the end of the month, we started with nothing. It has cost us in cash, we are behind in cash by £880, and so our closing bank balance now is £880 in debt. Now all that happens is at the end of that month, the closing bank balance becomes the opening bank balance for the next month. That makes absolute sense. Whatever we close on the 31st of the month must be what's in on the first day of the next month. Here we have we've got our in February. We've worked out what's coming in, and we've worked out what's coming out. And this month, our net cash flow is positive. We have brought in 1,100. We have paid out 930, so we are up this month by 170. We take that from our, we add that to our opening balance, and we are now not so badly in debt. We are only £710 in debt. Remember, that becomes the opening balance for the next month. Let's see if we can see any more good example here. What we very much hope, is that the closing balance, it usually dips a little, and then if we're lucky, it goes up and up and up. Cash flow forecasting is really important for things like seasonal products. So, for example, those big tubs of chocolates, Quality Street and Heroes, they'll start producing those in probably August, September, October, but they don't start selling them until October, November, December. So the business has to plan and ensure that they have enough cash. Their closing balance will be getting lower and lower in those months while they're producing the chocolates but not selling many, and then they need to, hopefully by the end of that season, the closing balance will have gone way up. But they need to be sure that the closing balance each month is no worse than the amount that they are allowed to borrow by their cash lenders. So I'm going to just talk about that a little more. So thinking about cash timings of cash flow, late payment. So credit control means chasing up customers who have not paid on time. You're controlling the amount of credit you give people. If a customer is late paying a large debt, then the business may have to ask for an overdraft or a loan from a bank, which can be expensive. So how do you improve your cash inflows? So to improve cash inflows or manage it, send out invoices promptly. Many businesses won't pay for anything they owe until they are asked for it with an invoice. You should pay for, it is worth paying somebody to chase up late payments. Remember, it can be the difference between surviving and not surviving. It's common for businesses to give credit to reliable customers, but if you have a new customer, you should not be giving them credit. You should not be allowing them to delay their payment until you know that they are reliable. And one way of encouraging early payment is to give a discount so that people feel that it's worth them paying earlier. And of course your outflows. So you can delay some payments. You can reduce stock levels, so you've stopped buying new money in while we allow the product to be sold. It may be that a business has a big project that it wants to start, and it should do the forecast. Remember, forecasting is predicting. We're looking ahead. We're planning with this document. It's not a past document. It's what should happen in the future, in the next few months. So you can watch, and if there is a big project, then delay the start of that. So, for example, a big chocolate manufacturer who makes those big tubs of chocolate would be mad to start building a new factory in June, July, August, September, when their inflow is reduced. Their inflow is reduced and their outflows, the cost of all the product that they're having to make and the wages for those is going up. So they should look at their cash flow forecast, see what the point is where they are likely to have the most cash in, and then begin that project. And make cutbacks to reduce your expenditure. So what are the benefits of using and the risks of not using cash flow forecast? Remember, this is where your higher marks are going to be coming in, because you're going to be discussing these. And what you're going to do is you're going to talk about these and you're going to follow through with so, therefore, this means that. And perhaps even evaluate for those really high level questions with a therefore, I suggest, I recommend what should be done. So the benefits of cash flow forecasting. It gives the timings of inflows and outflows. It allows a business to spot any short-term or long-term can be spotted quickly. Problems can be spotted quickly. It allows a business to know when they are likely to have surplus cash, and therefore they can invest. It lets a business know when expensive items can be bought, so as I say, projects can be started, and that allows for planning to expand or even reduce activities. If a business knows its costs, its cash outflow is going to be going up, then it can reduce other activities to balance that. So what could happen if you don't forecast, if you don't look ahead and predict what's going to happen? Well, you may not know when there's going to be late inflows and may not realise when you're going to need more cash. They may not have enough cash to pay their bills, and a business can go bankrupt even if it has capital, even if it has machinery and assets if it can't pay the bills it has to pay. So suppliers may refuse to trade with a business if they have a reputation for not paying. If they haven't predicted the cash flows and changed what they can change of the particularly the outflow, they may need to make an expensive loan or an overdraft which costs an awful lot more in interest, and the business may run out of business and cease trading. So what problems could there be? Short-term problems: delayed payments from customers, sorry we can't pay this month, or many bills arriving at the same time, or a large emergency payment. What can they do? Well, they can chase up those late payments. They've got to. It's worth having a resource, a human, doing that to keep that money coming in. If it's themselves, they may renegotiate a payment date. Another business will trust one more if they are honest and ask for a repayment date change rather than simply not paying when expected. And they could obtain a temporary loan. A loan, of course, is always better than going bankrupt, but if you can plan those steps ahead, then you may not need that expensive temporary loan. And long-term problems. They may realise that their revenue just is going down and down and down. By predicting this, by forecasting, they look at the long-term inputs and outputs and the long-term balance. They will see if expenditure is too high over a long term, and they see costs as they rise. So they get to see a long-term picture, that flow. They can, if they are lucky, increase sales, or other actions they could take. They may decide that they can change the product range, get different revenue streams, or reduce costs. This could be changing supplier. It could mean asking staff to take pay cuts or changing the pay structure, perhaps. And I hope that has given you an insight into cash flow forecasting. Remember, it's forecasting, it's looking to the future. Remember, it's all about cash. It's not about all their full assets. It's what they can get their hands on this month to pay what they can get this month from debtors. And remember also that although at first glance it can look complicated, it's really very simple. You have the inflows, you have the outflows, both of those are separately totalled. You take the inflow, take away the outflow to see how much extra has flowed in or out in a month. You start with each month with an opening balance, and then each month you take the opening balance away from the net cash flow, the net cash flow away from the opening balance, and this goes to your closing balance, which then forms next month's opening balance. Opening balance, take away net flow, or take away or add the net flow gives closing balance. Opening balance, add or take that month's net flow gives a closing balance. And you can see how it shifts across each month. It's not complicated, it's in small batches in predictable places.